Hello everyone, welcome to Just Invest Today, and today we have a good video for you guys. Today we're going to be talking about, are we too optimistic about the future? I feel like people right now, we're expecting very high returns in the future, but is that going to happen? Are we too focused on getting these really high returns, and is that realistic? That's what we're going to find out in this video, because this Wall Street article was really kind of eye-opening, kind of put me back in my place, kind of to see where I stand, see where I'm at. Even though I don't fully agree with this article, I want to get into it because I feel like a lot of us were expecting very high returns, but how likely is that going to happen? Not that it's not possible, but how likely is that going to happen? So I want to find out, are we being too optimistic? So let's get into it. When a 59% annual return just isn't enough, investors appear to be growing more and more optimistic about how their portfolios will perform in the years to come, and disappointment is bound to follow. So guys, tell me what you guys are expecting in your kind of portfolio. What kind of returns are you expecting? I know me, I have high expectations. Even though a lot of people might not say it's realistic, I still have high expectations. I want at least 20%. I want to average at least 20%. That would put me on the very top, but still, man, that's my goals, to get 20%. Guys, tell me what your goals are in the market. You think that's achievable? You think that's not going to happen? What are your thoughts on averaging 20% a year of investment returns? And guys, we all know everyone is so optimistic right now because of what just happened in the market. The S&P, everyone has just been going crazy, and we've been having this really strong bull market, strong run in the last 3 to 4 years, right? So we can say in 2019, the S&P did 28%. Let's see. Yeah. Averaged 28%, 2019, 2020, 16%, and then 2021 so far is average around 15 to 16%. Guys, that is killing it. Those investment returns will make you rich really fast if that continues. But that's putting a lot of expectations in our head now. So is that realistic going forward? What do we see the next couple years, 10 years? Because averaging 20%, 16, 17% is just not realistic going forward and getting those returns. So tell me what you guys think. So let's get into this article more and figure out what we should be averaging, or what we should be at for our investment returns. So in a recent survey of 750 US individual investors, even though that's not a lot, these people expect a 17.3% this year after inflation. That's what people are expecting. That's really high. That might not sound like pie in the sky. The S&P 500 returned 18.4% last year, counting dividends, up 15.9% so far in 2021. Recent past returns always mold future expectations. So that's what I've been saying. Our future expectations now are grasping. We're thinking we're gonna get 18, 19% going forward, even after we did so good in the past. So our expectations are very high, and I fall into this boat. I'm thinking yo, I want 22, I want 25% a year, and we all know that is extremely hard to get. So over the long run, however, the people in the Natixis survey anticipated earnings an average of 17.5% annually after inflation. That's up from 10.9% long-term return they expected in 2019, the previous round of survey. So people expected a lower return just in 2019, so not too far ago. But now people are expecting 17%, which is really strong. So this is where it gets good. It's also more than twice the return of the US stock since 1926, which averaged 7.1% annually after inflation. It's more than triple their 5.3% return over the same period after both inflation and taxes, according to Morningstar. So That's what the average is, guys. The average of the S&P is around 7.6%, and that's not even like. And then like after inflation, after taxes, that goes down lower. So are we being realistic, wanting 15, 20, 30%, like in 5, 10, 15 years increments? Because guys, we're not looking at 3-year results, 4-year results. We want these long-term compounding numbers. So what's a realistic goal to set? Is 20%? That's my goal. 20% at least. That's what I'm looking for. So hopefully, those goals come to fruition, but who knows, because that is extremely hard to come by. A Wharton Research data services which analyzes businesses and investing information to rank all U.S. stocks and exchange traded funds over the last 10 years. WRDS counted 3,790 stocks and ETFs that traded continuously over 10 years that ended May 31st, 2021. Only 14% earned total returns that exceeded 17.5 annually. Fully, 22% earned negative returns. So guys, only 14% average higher than 17.5 annually. And that's what the expectations, like, not a lot of people are going to be earning that much money, because if you were, you would be like, you're going to be founded as a guru, like, if you're earning those returns over the long run, 10 years plus, and you're being an S&P by that much. So, guys, are our expectations way too high? In short, investors are more likely to lose money than to compound it at least 17.5% a year. But what if you happen to pick the big winners? The biggest winners of all over the 10 years through the end of May was Tesla, up average of 59% annually. That's crazy. Other top performers include household names like Amazon, Domino's Pizza, Netflix, but consists mainly of companies probably you never heard of. So guys, look at these companies that are earning the high percentage: Amazon, Domino's, Netflix, Tesla. So is that a sign that we just have to pick these strong companies that we expect to win over the years? Like, I feel like picking Amazon, Domino's, Netflix, that wouldn't have been too hard for us, guys. Like, if you really think of it, picking those 4 companies, maybe Domino's would have been kind of hard, but Amazon, Netflix, Tesla, like, that is not a hard expectation when you see the future, like, where the future, like, economy is going. Like, Netflix, Amazon, Tesla, those were all strong companies that you can kind of see, like, okay, 5 years from now, like, EVs are going to be the future, Amazon was going to be the future, and Netflix, everyone was using Netflix, was going to be the future. So that's why I'm very positive on this, that like we can earn 20% a year, because picking those companies, I don't think it seems like some kind of stretch of our imagination to be able to pick those companies or pick the future of what you see is going on in the market, right? But then here's the big test: picking these type of winners that you kind of never heard of, but there are also strong companies. So like this, EVI Industries, up 45% annual over the past decade. So like, look at that, like EVI Industries, a distributor of commercial laundry and dry cleaning equipment. So look at those simple stocks that you could just pick. Simple, but the thing about, they might be simple, but they're not predictable, right? So these simple companies that are going to be lasting a long time, because dry cleaning, commercial laundry, those are always going to be like a thing. Like, they're always going to be needed. So I think those companies, it's possible to pick, but it's harder to pick. But that's why I see these Netflix, Amazons are those were easier to pick than these companies. Heska, 36% annually. Just consider Patrick Industries, which shares return an average of 56% annually, second only to Tesla. So these kind of undercover names are just generating huge returns. So guys, it's not always these big in-your-face winners that are going to be big stock winners. You can like pick these like unknown kind of like, but like really positive companies that are actually doing like kind of work, kind of companies that you really need. So if you somehow heard of Patrick in 2011 and had the bravery to buy it, would you have had the guts to keep it? Guys, this is all back to the 100 to 1 in the stock market by Thomas Phelps. Do you have the guts to keep your stocks, guys? If you think of it as like a house, or you think of it as a farm, just predict the future asset. Like, what is the future asset earning over time? Like, that's all that matters, not what the stock price is moving up and down and whatever it's doing. That's not what you're looking for. Warren Buffett always says, focus on the playing field, do not focus on the scoreboard. So if we're able to do that, you can see how we can compound really quickly and high. So in less than 3 months, in 2018, the stock fell 58%, and then early 2020 lost 69% in 25 days as the panic-stricken traders concluded the pandemic would kill demand for all kinds of housing. Today, even the epic gains over the past decade, Patrick still has a total market value of only $1.7 billion. To earn this gigantic return such stocks can provide, you need enormous skill. So guys, do you have this enormous skill, phenomenal luck, and the nerves and reserves to withstand blood-curdling losses? So phenomenal luck, that comes with the enormous skill. Guys, I don't think you need enormous skill. I think the biggest thing most providers says too, you just need the patience. You just need to be able to pick the winners. And what I mean by pick the winners, like, just invest in companies where you can kind of see or kind of at least estimate the future earnings of the company, and if it's undervalued, you buy it and you just hold. I say if you buy 10 of these companies, at least 6 will do really good if you invest like that. And then the main thing is having the patience to hold it no matter what happens if the stock is still getting better. And I think that's our advantage. That's our main advantage as investors, individual investors. We can ignore the market. We don't have to focus on the market like all the big Wall Street people. They're always constantly looking at the market, seeing what your stocks are doing. Like, guys, if we ignore all that news and we just look at it just as a business, I think we can make phenomenal gains. Like, if we just follow the simple path that Warren Buffett laid out. You just look at these stocks as businesses and you just focus on what the asset is producing. Do not focus on what the stock is moving and what the stock is doing and the economics of people, whatever they're talking about, interest rates, whatever they're talking about. Like, if you just focus on the stock, I think that's our main advantage as individual investors. In other words, you have to have enormous risk. Yet 77% of U.S. investors in a taxes survey say that if they were forced to choose, they would rather keep their money safe than earn a high return. So people don't want to invest. They don't want to go through those ups and downs, guys. They just want to have that. They just want to see their money in the bank account just doing really nothing. But now this article is saying, from today's level of interest rates and stock prices, it'd be thrilled if stocks return at least 4% annually over the next decade or two after inflation. So in this article, they're saying you'll be happy to get 4% after inflation, because we know inflation's going crazy. So they're saying that you'll be glad after this huge run of stocks to get 4%. Damn, man. Like, can you imagine only getting 4%? Like, oh man, that's mind-numbing. So guys, the article is predicting people are gonna get 4%. But I think that, hey guys, if we predict and we pick these good compounding companies, I think we can do way above 4%, because that just seems horrible, man. That's mind-numbing 4%. And I'd rather be surprised by earning more than expected than by earning less or by losing more. So guys, tell me what you guys think about this article, and do we have too high expectations right now going forward, because we've been having like the time of our lives in 2019, 2020, 2021, earning crazy amount of returns, 15% and above. So now they're expecting going forward it's going to be way less than that moving forward. So tell me what you guys think, man. Like, this article is crazy but good at the same time. It kind of puts your mind back in perspective on what you can get in the market. So tell me what you guys think. What are you guys expecting from the market? What are you expecting to do? Are our expectations way too high for the future? Should we calm it down to like at 7%, 6%, maybe 4% on what the S&P is going to be doing in the future? Guys, tell me what you guys think. Guys, if you like this video, like it, subscribe to my channel. I'll get back to you in the next video. Peace!